QuickBooks Pro Desktop 2021. Manage Sales Tax Form. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You can open the home page by going to the company dropdown, selecting the home page. We also have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list, making sure that it is uncollapsed with this little arrow here, making it uncollapsed. We're thinking about the managed sales tax item in the vendor section. So we're reviewing the vendor section, looking at the managed sales tax. The managed sales tax, I would think of it kind of more like a widget that is going to be there, and it's going to generate kind of like the pay bills item down here. It's going to generate basically a check or decrease to the checking account for the taxes that we owe. The reason it's in the vendor section is because we're basically paying somebody. We're paying like a vendor here, although it's not really a standard vendor. We're paying the government. We're paying the government for the sales tax. Now, this is a little bit weird because notice the sales tax is going to be something that will be on both sides of our cycle here, meaning we collect the sales tax on the customer side of things, and then we pay the sales tax on the vendor side of things. That's why they have this item up here, because this has to do with the paying half of things, meaning we're going to pay somebody, which is a vendor. We're not really getting anything. We're not buying anything like we usually would with a vendor. We're being forced to be the tax collector for the government. So let's think about how that would work, and then we'll talk about this in more depth when we set this up. So if you want to get into more depth about setting up the sales tax, you can take a look at that in the second half of the course when we do the setup process. So setting up the sales tax is going to be the more difficult part. Once set up, it's going to be it should be easy, like most things, to basically manage it. That's the point within QuickBooks. We want to basically set it up so that the data input will be an easy process. Now, remember that the sales tax in the United States is a state and local tax as opposed to a federal tax, and therefore will change from state to state. The QuickBooks system has gotten a lot better at being able to identify the different rates from state to state, but because they will vary from state and locality, it'll be a little bit more confusing to pick up the rate. Now, it is a usage tax. So if you're in an area where you have like a usage tax, it's the same kind of concept for taxes. There's no new taxes really. It's just how we're applying the same old taxes in different areas, right? In the United States, we have an income tax for the Fed, and then the state can have any tax they want, including basically a sales tax, and the state and local tax might include a sales tax. So notice the concept of the sales tax is this. The concept is that you have the government, which is a third party, right? When we talk about the business, it's an A and B negotiation. It's us and our customers that we're talking about on the sales side of things, right? When we sell stuff, it's between us and the customer. But then you got the government that steps in here. And in our case, the state and local government at this level steps in and says, hey, we would like to charge not really us, the business owner, but the customer. So the government's basically saying, hey, look, this tax isn't on the business. Now, again, economically, you can argue whether who's actually paying the tax and whatnot, but the concept is the government stepping in and taxing the customer. So why are we involved in it then? Why are we, the business owner, involved? Because they're forcing us, because they have leverage to force us to be the collection agency. So really, we're not the ones that are charging the tax, even though we're kind of like charging the tax, right? The tax is going to be included in when we create an invoice and a sales receipt, the items that are going to be there when we charge the customer. We're going to have to tack on the sales tax. But in theory, the sales tax isn't us charging it's the government that's forcing us to be the tax collector, and that's the concept. Therefore, we're not really recording the sales tax as revenue, even though we're going to be collecting it, but rather as a payable. And then we're going to have to collect that for some time period, and then we will pay it, writing a check or making some other kind of payment that will decrease our checking account, basically a check type form that will then be going to the government in order to pay the tax obligation. Now, just a quick rundown of how this kind of works and how this will be set up then. If you go to the preferences dropdown, we're going to go to the edit and preferences. And there's a couple components you need to set up. One will be the sales tax down here. And then in the company preferences, we'll do this when we work through the practice problem. We'll have to turn on the sales tax. We'll have to assign a vendor. This is where the vendor comes into place. This is the government that we're going to be paying eventually after we collect the sales tax, and then we're going to be paying it out. These are the icons that will show up to show that it is going to be a taxable or non-taxable item. In the US, inventory items are often taxable, have sales tax applied, while service items will often not be taxable. Then there's the logistics of how and when are we going to be paying the taxes, meaning how are we going to collect them and when are we going to be paying them? Meaning if we're charging the customers as we bill the customer, then when we collect the tax, when do we then owe it to the government? Because we have to collect it and then pay it at some later date. So we could then be collecting, for example, on a monthly basis, meaning we would be collecting for like the month of January that we would then pay like in February. We would have to pay the sales tax that we collected in January from the customers in February. Or we might pay quarterly, meaning we would collect the sales tax for like the first 3 months, January, February, March, the first quarter, and then pay the first month of the fourth quarter. We would pay the first quarter in the first month of the second quarter, right? And then we could do it annually. And so these will typically depend on how large our sales tax are. If we have a lot of sales tax, then the state or locality are more likely to want to get their money sooner. And if we have less sales tax, they might allow us to do it to pay later. There's also a question of when do we pay when do we actually get incurred the tax that we have to collect? Because do we collect it when we give the invoice, which is before we actually got the money? Do we have to include the sales tax in the month? For example, the month of January, if we invoice the client, even though we haven't got the money yet? Or do we basically get to include the sales tax when we get the money, which would, let's say in February, we actually got payment for an invoice that went out in January. So there's a question of when do we count the sale being in place here? And again, that'll change from state to state, locality to locality. Then you'd have to set up an item, inventory items typically, lists, and we'll see this later. This is one of the more confusing components, lists, and then we have the item lists, and then we would set up our inventory items would be the ones that would then be taxable. So if we were to edit an inventory item, right-click and edit the item, we can then see that this is a taxable item indicated by the tax here. So that would be taxable. And then you might have to have some customers that would not be taxed, meaning this would usually be all you need. And then all customers would be driven by whether they would be taxed or not by the item that they would have. But you might have some customers that would be tax exempt. In that case, you would have to go into the customer center, and then you would have to pick those customers that would be exempt from taxes, and then double click on them and indicate that they would then be exempt from the sales tax, which would be here. That would be rare. That would be kind of more unusual. It's usually driven if you're dealing with end customers being like the end customer, then typically they'll be subject to tax based on what they are purchasing, goods or services. So closing this back out, then the basic concept of the sales tax then will be when you create a sales receipt or invoice on the customer side of things. If we take a look at one, for example, I'm going to go into the invoice and I'm going to go back to one that has an item that we sold. So here's an item that we sold. This was in March 3rd. This is an inventory item. We'll talk about the invoice a little bit later on how to record it. But just note that what happens here is we got this guitar that we sold. We only charged the $380. That's our price. But then we had this 5% sales tax. We didn't charge the 5% sales tax. Therefore, that $19 doesn't really go to us. We don't record it as income. That's not going to be recorded on income, but rather, as soon as we create the invoice, it's going to be on the payable. So the key point here is instead of us increasing income and then having sales tax expense when we pay the sales tax, which would be 2 items on the income statement, which would net out to 0. Instead of that, we're never going to hit the income statement, but rather hit a liability account, increase the liability for that $19 at the point in time that we enter the invoice. Never hits the income statement. There's no expense related to sales tax. There's no income related to the sales tax. It's all going to the payable. We're just the collection agency. And then we'll pay it at a later point in time. So let's just take a look at that on the financials. Now notice this little widget is a format to pay it in a similar way as the payable item here. So once you have the sales tax set up, rather than just writing a check down here, the little widget up here can help you to calculate the proper payment. In other words, if I click on this widget, it'll be a little bit easier for us to pay the sales tax for the amount that is due, for the time period that is due. So for example, if I had to pay for the first month, I would want to say the check date, let's say, was on 01/31, or probably sometime in February, 02/28/21. I won't actually record this, obviously. And then to show the sales tax due, 01/31/21. So, and there's none due right now because we already paid it. But notice we'd have to put it that way. Let's do this at the end of, let's do it the other way. Let's say this is 03/15/21, and this is 02/28/21. So as of the end of the February, we have this 288 sales tax that we're going to be paying then in March. Now, if we were to process this out, it would basically create a check, which is a decrease to the checking account, but it would indicate that it's a special check that used this widget, and then the other side would be going to the decrease of the sales tax. Let's take a look at that. I'm going to close this back out. Close this back out. Let's open up our reports, our major reports, those being the financials, by going to the reports drop-down, company and financial, down to the balance sheet standard. I'm going to change the dates up top in the customized reports so that we can zoom into it by changing it to 01/01/21, 12/31/21, and then OK. So if we go down to the sales tax, it's going to be a liability item here. So if I'm going to go down to the liabilities, I'm going to, hey, there's the sales tax. Now we have two accounts because there was this, there'll be an adjusting entry related to it. So we'll see that later. But in any case, I'm going to double click on the 307 to zoom into it. And what we'll see here is the sales tax increasing every time we have an invoice or a sales receipt, because those are the items on the sales side of things that we're selling to the customers. And then down here, as of the end of January, you'll see that we had, as of the end of January, we had collected or we had been charged for the, because we may not have got it yet because we have invoices too. But in any case, we have been charged our clients $1,697.70 in sales tax, which we then paid down here. We paid it with our little sales tax widget payer thing. And so now it says sales tax payment. So this is us using that widget to pay off the prior month. And notice that's going to be a decrease to the sales tax. If I double click on it, then we see that it's a check form. Once again, looks like a normal type of check. It looks kind of like the bill check in that the bottom half of it down here has this funny thing down here instead of just a count that we hit. But this time it's going to be for sales tax, so it indicates it right here. So it gives us a nice little indication. And we want to recognize that basically this is still basically a check form, meaning it's the form that decreases the checking account. But it's a special check form in that it's going to tell us that the other side is going to the sales tax, and this also tells us that we were using a little widget to do it. We didn't just write a check, which we could have done. We could just write a check, but it's useful to use the little widget that they give because it's more likely that we will not make a mistake if we set it up correctly to do so. And then, of course, we paid it off, and then we were accumulating sales tax in the month of March, and any sales tax in the month of March would still be owed. There wasn't a lot of activity on taxable items. In the month of February, we accumulated up, which would then be paid in March. There weren't a lot of taxable items, more service items here in the month of February. Now, the other side of this, if I close this back out, the other side of this is going to be on the checking account, double-clicking on the checking account, and we paid off the sales tax sometime in March, so we should have that same, and again, it's nice to have this little type here that gives you that thing, because then I can go right down, there's the sales tax. And you can actually sort by type too. If I wanted to sort this report by the type, then I can find this sales tax quite easily. And so here's the other side of it. And if I double click on it, there's again us paying off the sales tax with something that looks, which basically is a check, but it's a special type of check, and it indicates that in our detail. Closing this back out. If we want to see this on a trial balance, it's useful to see these on a trial balance as well. I would practice using it even if you're not used to debits and credits, hitting the reports drop down, accounting and taxes, trial balance, dates up top from 01/01/21 to 12/31/21. And once again, you can go into your checking account here. You could scroll down and you can look for that sales tax payment. There's the $1,697.70. We basically decreased the checking account. The other side, not going to an expense. It's not going to hit the expense. Instead, is going to go to that sales tax payable. So there's the sales tax payable, double clicking on that. And there's the other side of the payment that was happening. Now, again, most of the time, if I close this back out and you see a payable, most of the time you see a payable like you see the accounts payable up top, you think, well, it must have hit the income statement sometime, It must have hit the income statement, when I increased the payable. But in this case, it's weird. It didn't. Like, right? If it was the accounts payable, in other words, when I pay off the accounts payable, I actually hit the income statement usually when I increased when I entered the bill. Meaning, if I entered a phone bill, I entered a expense for the phone bill, and the other side went to the accounts payable, and then I paid off the accounts payable, decreasing the checking account, decreasing the payable. So the income statement was hit. It just wasn't hit at the point in time that we paid off the payment. It was hit when we entered the bill in that case. Or if we bought inventory, it wouldn't be hit when we entered the bill or made the payment, but would be hit at the point in time we made the sale of the inventory in the form of cost of goods sold. That would be an expense account. But here, it never hits the income statement. That's kind of the funny thing with sales tax. It's kind of hard to, it takes a little while to wrap your head around. And here, we don't have sales tax expense even though we're paying sales tax. Well, how can we not have an expense if we're paying the sales tax? Because we charged the customer and didn't record it as revenue. We didn't record the sales tax portion of what we charged as revenue because it wasn't us charging it in theory. It was the government charging it and forcing us to be their tax collector. Therefore, it never was revenue to us. It's something that we were forced to collect by the government and therefore went directly into the payable account. And when we pay it then, it's not going to be an expense because we didn't record the income related to it. It's simply going to decrease the payable account, and it just bypasses, never hits the income statement.